For someone that bought a Tesla for $78, his Las Vegas home for $0, saves money by drinking 20-cent iced coffee, and fiddles with grocery bags so as to not need to spend money on actual garbage bags, you're obviously someone that likes to get a good deal and use their money wisely. But, and I love you, man, and you're the one that inspired me to start making videos. However, I gotta get this off my chest after watching your recent stock portfolio reveal video.
Macy and I decided to order from the Cheesecake Factory as a date night, and when we got there, we saw that the place was packed. So I decided to invest $32,000 in a company that I like and use myself with the expectation that with that much demand, they're unlikely to go under. Well, since
there's a lot of businesses that I love, but I don't buy their stock, and I wish I could. Unfortunately, just because you love a company and see them with lineups out the door, doesn't by default make it a good investment. Graham, I'm gonna let you in a little secret that you actually already know, but you just don't realize it. You're a real estate guy, so let me break it down like this. Imagine the most gorgeous apartment building in the world's greatest location is up for sale. This place will generate tons of cash and is virtually guaranteed to be highly sought after forever. And you've been given the opportunity to buy this amazing property. You love the property, so your interests are at least piqued by the opportunity. What would your next step be? What kind of things would you think about before making an offer on this property? Now, I know you like to get a good deal, Graham, so I'd imagine you take some time to try to figure out what it's worth and what you think would be a good price to pay for it. Whatever your method of figuring that out is, I'm sure what it's worth to you would have something to do with how much cash you could get back out of it in the future. Obviously, there would be a limit to how much you'd be willing to pay, no matter how great the property was. There would be a price that's just simply too high for it to be worth it. And if the seller was only willing to sell you at a price which you believe made it a bad investment, an investment that would give you below average returns at best, you would pass. Or you'd negotiate them lower, or you'd just wait and see if it came down in price sometime in the future and then reconsider it then. Because even if it was the greatest apartment building ever, if your calculations are telling you that paying the asking price would result in an investment that would give you just 3% annual returns at best, then it would be a natural conclusion that you'd be better off putting that money into an S&P 500 index fund instead. Likewise, there's a price that could make it a great investment. A price that could give you an annual return on your investment of 15 or 20%. The same property, just a better price. That's why we like getting deals when it comes to investing. Lower price means better returns. But then why should buying a company be treated any differently? After all, that's what stocks are. Whether you're buying a company in whole or in part through buying shares of its stock, how much you're paying in relation to how much it's worth is what determines your annual rate of return on that investment. For some reason, and I haven't figured out why it is, but when it comes to buying an entire apartment house or an entire company as an investment, it's so obvious to everyone that the price you pay is an important factor. It determines whether it will be a good investment or not. But the moment a company's ownership has been divided up into a million or a billion pieces called shares of stock, all of a sudden, even for the most money-savvy people, figuring out what those shares are actually worth before you buy them gets thrown out the window. Who cares what it's worth? I like the company and I'm buying it. Did you see the lineup coming out the door of that place? How are share prices even determined anyways? Who knows? Don't care. I'm buying. This disregard that most people have for what stocks are actually worth is exactly why Warren Buffett says that most people should just buy index funds on a regular basis. Yes, low fees are great, amazing. I love index funds, but that's not why. If you do this buying every month, some months you'll be overpaying, but some months you'll be underpaying. And spread out over your lifetime, it'll cancel itself out, and you'll have ended up paying a fair price on average. And without ever needing to do the hard work of figuring out what you were buying was actually worth. Just like how you can figure out what an apartment house is worth, figuring out what a company is worth is absolutely possible. And that's exactly how Buffett became one of the richest people in the world. He took your 20-cent iced coffee approach and applied it to stocks. All public companies are always up for sale, and the price tag on them is just whatever the shares last traded for. However, this price is far from efficient. Just look at GameStop, for example, and you can see how inefficient prices can be. Its quoted market value went from $2 billion up to $22 billion and then back down to $3 billion in the matter of like a week. The dot-com bubble is another great piece of evidence that points to the fact that stock prices aren't always efficient. Stock prices are largely based on emotion. The guy who taught Warren Buffett the art of value investing, his name was Benjamin Graham, and he would say, in the short term, the stock market is a voting machine, but in the long term, it's a weighing machine. Now, if you're buying in the midst of a serious stock market panic, then yeah, chances are you'll be getting a good price for what you're getting. However, you could just as easily be paying a moderately fair price for a stock that was previously overvalued. Stock prices are always dancing around their true value. Often they're overpriced from being bid up by all the investors who are just treating it like a casino. But sometimes they can be underpriced too. Underpriced to the point that it would make Warren Buffett's mouth water. Delicious stocks. A lot of people don't realize where the money even goes when you buy a stock, or the fact that stock prices are set by the small number of investors and traders doing the buying and selling. The act of someone trading one single share of stock at a particular price instantly sets the price of those shares at that price until the next shares are traded. A long-term holder of a company's stock who gets how it works and knows what the shares are worth could watch in amusement as the quoted market value of his holdings drops by 20%, for example, simply because a small number of investors panic sold their shares. And who do you think they were panic selling to, by the way? If you don't know what you own is worth, then you're gonna be taken for a ride. And your investment returns are also gonna suck. Buffett and other value investors have become so incredibly wealthy by exploiting the fact that most people don't get it. Most people do just buy stocks because they had a good feeling about the company, and that's that. But those people will also be the first to panic sell out when the stock drops. If you don't know what it's worth and it drops by 30%, what are you gonna do? What if it drops by 50%? Will you hold on? Listen, buying great companies that are growing and that you feel have a great future and that you're planning on holding on to for the long term is not the worst approach in the world. Absolutely, I'll give you that. Chances are though, your investment returns would be better if you were to just stick to your bread and butter of buying index funds consistently month after month. But for those of you watching who love money and want to be filthy rich, well, the difference between 8% returns and 15% annual returns is obnoxious. If your goal is to become incredibly wealthy, you gotta pay a good price for your stocks. But paying a good price, believe it or not, has nothing to do with what the price was previously. Seeing that a stock's price has dropped by 50% does not mean that you found an opportunity to buy an undervalued stock. Likewise, on occasion, you could buy stocks trading at their all-time highs and still be getting a great price. So how do you make sure you don't overpay? It's simple, but it's not easy. It's all about figuring out what it's worth. What it's worth, same as the apartment house, will have to do with how much cash it can generate for you in the future. That's all investing is, after all, laying out cash now to get more cash back in the future. So if you think saving money drinking 20-cent iced coffee is badass, let me tell you, buying a piece of ownership in a great company for a fraction of what it's worth, now that's badass. Long ago, Warren Buffett's teacher Benjamin Graham taught him, price is what you pay, value is what you get. Now when I talk about Warren Buffett and value investing, there's always someone that chimes in saying the stock market is different now and that the old ways don't work and that value investing is dead. But it should make sense to you that your investment returns will depend on the price you pay and the value of what you get in exchange. What an investment is worth, its value, is dependent on how much cash you'll be able to get back in the future and when you'll get it. In Warren Buffett's words, what is investing if not the act of seeking value at least sufficient to justify the amount paid? Him and his business partner Charlie Munger would tell you that all intelligent and rational investing is value investing, and that everything else is just speculation. Remember, shares are just fractional ownership of companies. They're not lottery tickets. Now, it's no secret, by the way, that I'm trying to piggyback off Graham Stephan's popularity by making this video, so please don't hold that against me. I absolutely love Graham, and I promise you, I destroy the like button on every single one of his videos. In making this video, I genuinely set out to make a video that I thought would benefit him, the same way that I would try to help out a friend who I wanted to see the best for. An apartment building is concrete. You can drive by it, you can touch it. It's a lot easier to think rationally about them as investments. Stocks are an abstract idea. There's nothing you can actually touch. And because they're so abstract, it really does make it that much harder to think rationally about them as investments. If I piqued your interest at all with this video, this is another one that you're gonna like because I go more in depth into how to figure out what a company is worth. And for those of you that wanna stick with index funds and keep things simple, I would suggest watching this one here where I also suggest my favorite index fund, which is little known but has a slight advantage over the popular S&P 500 index fund that you're used to. Please consider hitting the share button below this video, copying that link, and sending it to your friends that are about that stock and investing life.